officially going to kick it off. Welcome to everybody. My name is Anthony, and I'm the co-founder and head of product at Daba. And I'm excited to be your host today for our second webinar that will focus on assessing startup deals. We want to thank our team. On behalf of our team, I want to thank Aya for being here, as well as all of you who are joining, on a Friday. Oh, wow. Umaima from Morocco. Great. Before we introduce our incredible speaker, Aya, I just want to take a minute to tell a bit more about what we do at Daba. At Daba Finance, our mission is to provide you with the best investment experience in the African capital markets. We believe that to power the next generation of Africa-focused investors to make the best investment decisions, it is crucial to give them access to investment insights, investment tools, and educational content such as this webinar. The format today is very simple. It's a 30-minute conversation, and then we'll open it up for questions. So I hope you're ready with some questions for Aya. With no further ado, I would like to welcome Aya. Thank you so much for being here. And Aya, could you please introduce yourself to the audience?
Thank you. Thank you so much, Anthony. And hello, everyone. I cannot unfortunately see who's with us and who's not, but I hope that, Anthony, perhaps you can tell me about the questions, and if there's any comments, I'm actually happy to stop at any time. So my name is Aya. I am currently in Morocco. So I'm an investment professional. I work currently in investment banking, and I also do some angel investments, as some of you might know. I currently have around 15 companies in my portfolio that are mostly based in Africa. I recently invested in Egypt and also in Dubai, in the UAE, which to be announced quite soon. What perhaps else? I advise GIZ and their AgTech and food tech programs across Africa, which I'm particularly proud of. I have been in multiple African countries. I'm actually planning to even, go to, all the 50 quite soon. So I'm planning to kind of split Africa by regions and kind of travel around just to see how we can impact our continent even more. As you might know, I actually like impacts, and I like impact investments specifically targeted towards startups, because I do believe that SMEs are actually the backbone of our economy. And I also even believe to the power of technology companies and the power of entrepreneurs. I have seen many passionate entrepreneurs around, around Africa. I've also seen the fact that Generation Z and millennials are trying to invest more into companies, which I'm actually glad to see and to also support. So yeah, I'm actually planning to invest even more into our countries, specifically into countries that do not get a lot of investments, such as French-speaking Africa. I'm also planning to invest more into, let's say, least developed countries of Africa, such as Sudan, such as Ethiopia, and even Chad and Togo, actually, if I get the chance or if I get the pipeline. I have a VC that would actually be launched quite soon. It's a fund that actually came from the Middle East into investing into Africa. So planning to disperse around January. And yeah, I'm actually very happy to have this conversation with everyone. And I think it'll be good after what you think, Anthony, to kind of make it completely informal. I'm happy to stop whenever there is a question for us to answer. And let's just have a good discussion.
Amazing. Thank you again, Aya. I think, quite impressive, background with everything you've shared. Looking forward to hearing more about your funds. I'm sure as things come live, and as
background with everything you've shared.
What I wanted to say is, when did you get started investing in startups? How long was that ago, and what was it that made you jump into it?
So I started about a couple of years ago. I think I was 22 at the time. And my first company, I hope they're actually watching us, it's called Winnage Farms, which is it's an AgTech basically based in Nigeria. How did I start and why did I make the jump is basically because I used to be an entrepreneur. So when I was in college, I studied here in Morocco, but then when I was in college, I had the idea about making this e-consulting company with one of my partners in Morocco. The company unfortunately did not go so well, and I knew in me that I don't have the guts to be an entrepreneur. And I'm actually happy saying this live, because everyone, being an entrepreneur is not actually something that is quite easy, and everyone have the thing that that they can do best. There are people who are good at operations, there are people that are good at management, there are people that are good in finance. And I was lucky enough to discover that I was good at the financial part and the investment part from early on. It could have taken me actually a lot of ups and downs to do that. So my failure as an entrepreneur actually made me think that I would be better off from the investor side, because working with companies from a strategic level, from actually making sure that the company's finances are up to the point and kind of innovating around financial instruments was actually something that I would do best. So at 22, I actually decided that instead of me also being focused on one sector or being focused on one company, why don't I just go ahead and invest my savings across multiple companies in multiple sectors? And it was actually good for someone, like myself, who cannot really focus. I'm not someone who likes to focus on one thing and do one thing. I get bored, which is actually true. This is why you might see me doing a lot of things. But so investing in startups is actually a very good idea for Generation Z like myself, or also millennials who like to do a lot of things, to see a lot of things, and even learn from a lot of companies at once. I consider investing in companies a learning opportunity because I get the chance also to learn about the various challenges and opportunities in multiple sectors. I've worked in sectors like ag tech, food tech, supply chain, logistics. I've also worked, briefly on blockchain, and it has been, really fun. And I also encourage people to kind of know what they can do and pursue it.
This is a great, pretty much, introduction into what we're going to jump into, because, just to give a reminder, today's session is all about how to assess startup deals. And, from someone like Aya, it's going to be very interesting to hear a perspective from an operator, from someone who invests as an angel investor, certainly in the future with a VC fund, and as well as someone who's on the board of one or multiple African tech companies. Is going to be very interesting to hear her perspective on that. So thank you for sharing that. And the last question before we jump right into how to assess startup deals is there a startup that you have a weakness for, that you're the most proud to have invested in or even supported? It doesn't have to be invested.
Okay, so the question is there any startup that I'm mostly proud of?
That you're mostly proud of in terms of having invested in or supported?
Oh, actually, it's a tricky question. I have a lot of them, to be honest. I'm mostly proud about all the entrepreneurs that I've backed or that have backed me in the last few years. And let's say that I'm particularly proud about all of them, to be honest, even those who failed. Because again, failure is just people move on, basically, and failure is actually the best step, or the step to success. So it happens, and I'm sure everyone failed in their lives. I can say particularly Winich Farms, which is the ag tech that was my first investment in Nigeria, because I've seen the impact that they have done across smallholder farmers in Nigeria, around Lagos and Abuja, which was actually quite interesting. I've seen that farmers' lives have actually changed. Which is one thing that I like about Africa, is that we have a lot of structural issues that we need structural good companies that can actually fix those issues. I'm not speaking actually about some sectors that are like a luxury. Let's say, for example, Web3 sectors or gaming sectors that are actually quite, that are increasing in momentum and are definitely good investment opportunities. But in Africa, you would see that we still need those companies that will still work in few sectors that are marginalized. Agriculture are one of them, because the microholder farmers are having a lot of issues. So I'm basically part of with Winich Farms, what they have done. Going also to the health sector, their portfolio company, Zuri Health, which is based in Kenya, they've actually done a lot of work to kind of help consumers, such as myself as well, to get the health advice needed through SMS channels, or also to get the lab tests that they need. Zuri Health is actually creating a virtual hospital, which is completely needed in countries like Kenya and even in Morocco, which by the way, Zuri is scaling to Morocco and the rest of Africa. I'm particularly proud also about a company that I have in Sudan, and this company is called Terhal. Again, the impact they're making is amazing, because Terhal is really the Uber of Sudan. So whenever you go to Sudan, you'd actually order a Terhal directly. So they have the brand, and they actually allow people to go from point A to point B in a third world country like such as Sudan. I can go on and on. I have about 15, Anthony, to be honest, but also good to mention Melanin Capital, based in Kenya as well. Good to mention e-youth that is based in Egypt, which basically does education platform, which is an education platform that they have trained more than 300,000 youth around Saudi Arabia, Dubai, and also Egypt. But to summarize, because we can't go through each one of them, I like impact, and I like seeing that companies are actually making money out of doing something as impactful as what they do.
Amazing. Clearly, there was not one specific favorite. All are favorites, and
All I did.
it was a tough question. So thank you for dealing with that already. So we have really one goal today, at least the goal for this workshop is really webinar is for our audience. When we'll finish the session, to really have a more critical lens of how to assess startup deals. So the first question that I have for you, Aya, is we're at a specific time, point in time where several startups are launching, and even though angel investors are growing in number, they are eager to find, these startups are looking to find capital, looking to raise money across different channels. As an angel yourself, putting aside your venture capital hat, how do you go about sourcing deals?
Actually, sourcing deals is one of the easiest things that you can do. And I know that a lot of people think that it's hard. It is not, just because we have a lot of entrepreneurs and a lot of distribution channels, across the continent. And the good thing also is that we have an interconnection between all the VCs in Africa. We have events that kind of connect all the VCs in Africa. We even have WhatsApp groups, LinkedIn groups, by which all the VCs, angel investors, share their favorite company or their favorite pitch deck. As a small angel investor myself, I get around 5 to 10 pitch decks per day, almost, just via LinkedIn channels and just via announcing that we do actively invest. You can actually get people now to send you their decks. Now, if you're asking how to get quality, pitch decks, by quality I mean investable companies that are ready to actually, that are ready to get investments. This is something that I get usually from my relationships with venture capitalists, with VCs around Africa, and my relationships with angel groups in companies such as Daba, for example. So you build a relationship or rapport with the VC. And the VC, for example, once they see a company that they like, but it's not at the stage of them investing, because most of the VCs actually like, proven traction, proven growth, they might actually send it to you. And they tell you, okay, here's this company. I actually like it very much, but we cannot invest now because we do have a mandate. The best thing about angel investors is because we control our money. We don't pay the, we don't actually use the money of someone else. We control our own money. So we're really flexible. Like, we do not have a clear mandate. We can basically invest in anything that makes economic sense for us. Which is why VCs actually, once they have a good company, they share it across. Angel groups as well, once they have a good company that is good for a particular angel investor, they share that across as well. And then, we keep in contact. So to answer your question, it's just via communication and just via social media and groups. By announcing that you're an angel investor, you would actually get deals automatically.
So I think a good way to summarize what you just said is the following, right? You can easily find startups everywhere. That part is not difficult. Everyone can find startups. I'm sure a lot of people must have had someone reach out on LinkedIn or via email saying, hey, I'm building this. Are you interested in investing in my company? However, the more difficult part really is to get access to quality deal flow or opportunity that are a little bit more vetted, that are a little bit more attractive in terms of traction, and have validated a certain market, perhaps even a little bit later stage, not always. And these opportunities are usually found across, being part of specific communities, not always, but being part of or in touch with key tech ecosystem players, communities such as the Daba community, venture capital, and other angel investment communities. And
exactly. Yeah.
And I think this is a right moment to start talking about analyzing deals, right? Now we said how are the ways that you can get deals and quality deals. Now the question is, do you Aya have a specific framework. So we're using today our angel investor hats. We're forgetting mandates and VCs for now. Today, we're just really focusing for you as an angel investor. When you receive a deal, whether, I mean, of course, usually what we'd like to say is that when a deal comes from someone that you trust and, is a warm introduction or warm lead, it usually takes a different priority on the list of deals that you analyze. But how do you is there a way that, number one, is a multiple question, right? So number one, how do you conduct due diligence in startup deals? Let's start with that. And there is some, of course, just to touch on this, this specific webinar, we are mostly talking about African tech companies, but I know you've mentioned that you invested in Dubai. I don't know if you invested in Latin America or North America or Southeast Asia. Just curious, how do you go about doing due diligence when you see a pitch deck, right? Before you say, hey, I want to invest, or before I like the idea, what is the first thing to do when it comes to due diligence?
So that's actually a very good question. Now, starting from scratch, when I started investing, which is 2 years ago, I was actually quite shy, meaning that in order for me also to learn how best I can support the entrepreneurs, and because I don't have capacity, or I'm just one person, I thought that the best way to do this is, first of all, start by advising startups, which I've been doing across specifically in few sectors with my mandate with GIZ, or with with the World Bank or with other institutions. And basically, I spent 6 months with startup as an advisor. And then once I actually like the startup, for example, the company Winich Farms, the Agtech one, in order for me to invest in it, I've seen more than 100 and advised more than 100 similar ones. And then I picked the one that I liked the most. And that's actually the one that, I began formally advising. Of course, taking care of the conflicts of interest in. So it's something to be avoided as well. So at first, I started by only advising a lot of companies in order for me also to get the benefit or to understand what it is like to be an angel investor, understand the sector, being hands in hands with. I've even went through actually going checking their clients, talking to their clients, talking to them, trying to solve the solution, their problems, or sitting with them having brainstorming sessions. It was actually quite important just to figure out what kind of angel investor am I. Needless to say, to open here a bracket, because investors also, there are a lot of types of of angel investors. There are investors who actually want to be involved hands-on and want to be part of your business, like you get as partners. And there are some angel investors that have a strategy to shoot multiple companies, and then some of them would actually be good, but they don't really get involved with companies. And both the business, both the investment strategies are valid and they're correct and they worked. But I just had to figure out what kind of angel investor am I. And I've actually chosen to go the advice side, like to be hands-on with companies, and kind of like try to understand it more, not only for the company's sake, but also for myself, my own development. Because once you get involved, you kind of know now what happens, and you can be able to kind of understand how companies in Africa, in each specific country, in each specific sector, handle their own activities. So that was what I used to do before. As I discovered what am I and what style of investment I do, now I can actually invest just after, and I know it's not going to be good to say it loud, but I can invest just after 30 minutes of a really good pitch, because I came to understand, especially if a sector that I really, really understood. Now, if a sector I understand and I know the opportunity is good and I like the founder actually quite well, and once I have a pitch with them, if they have a VC that is involved in the conversation, meaning a good VC, meaning that they have done due diligence, I can actually get in immediately after 30 minutes if they have good VCs in their cap table. Now, if this is an idea stage and they don't have a VC in their cap table, then I go back to my original, way, which is basically advise them pro bono, for free, of course, for 3 months until I get to know the founders well and I'm very comfortable with them, and then I invest. So there are two ways. If there's a VC, or if it's actually quite advanced, like a pre-series A company, I can go in without due diligence. If it's not a pre-series A, like an idea stage or pre-seed, that they don't have actually a lot of people in the round, then I go, I spend 3 months just to get to know them, advise them, even visit them. And once I'm quite comfortable, I get in and invest.
Now, thank you for sharing that. And I think, one thing that we try to do at Daba is how do we get the investor as close as possible to the company to really understand the dynamics and really have been able to communicate with that investor, with that founder themselves. Um, so I completely understand. I think it is very important to, I think, get as close as possible to the startup founder, understanding how they're operating, what they're doing. And we have a really, really good question that I'm going to display here. I don't know if you can see it, Aya, that came from the chat from Lolan.
I can
Uh,
see. No.
you can see it? Uh,
No, I'm actually using, the stream.
oh,
The
oh,
stream
oh! I
yard.
thought you were on the
Not
on
on
the on the
YouTube.
StreamYard. So
Oh, I can
the
see it.
question, you see it
Okay.
now?
Yeah, I can.
I think the question just fits perfectly, what you were touching on. And the question is, do you typically invest on your own or through angel consortiums? If you invest on your own, do you do every aspect of the due diligence or do you outsource legal and other forms of non-financial due diligence?
Okay, so it's actually, thank you, Lolan. So I actually do both. Normally, I invest in my own for deals that I actually believe in, but it's hard for me to source throughout the other investors that I know. I would invest in my own in that case. My tickets are between $25,000 and $75,000. I can go up to $100,000 if I'm actually really convinced, but I rarely do that. So I like to keep it between 25 and 50. Now, if the deal is actually at some point actually something that is good economically, of course, in terms of valuation and everything else, I just invite my friends in. I wouldn't call it an angel consortium because what we do is that we just make a special purpose company, either in Delaware, either in Abu Dhabi, or either in Dubai, and we just, and we just get, I just get my friends to come in, and they come in with my name basically. For example, if I want to raise $1 million, and I wouldn't invest $1 million on my own, of course. What I do is I'll create a special purpose company, and then I'll get investors to come in from my side, either investors from the Middle East who are just friends of mine, either investors from the US, and I end up managing that portion, meaning that the contact would actually be with me, and I would do the due diligence, not them. So there are two ways, depending on the quality of the company. Um, Now, if I invest on my own or through a consortium, I have to manage that consortium. So in both the cases, I would have to do due diligence. Now, if the company already has a venture capitalist, meaning it already has an institutional investor, I just go with the due diligence that the institutional investor is doing. That is legal due diligence. And usually the institutional investor does outsource the legal due diligence, which is most people actually outsource is because we cannot do it on our own. None for financial due diligence, we do it on our own. Technical due diligence, we actually outsource. We get someone who is, someone who is, a consultant that is actually quite good in technology that would do, the due diligence for us. But let me tell you just one thing. Now, if the deal is $1 million or less, we don't actually do all the aspects of due diligence just because it's expensive and it's not actually worth if the deal is $1 million or less, for us at least. Now, if the deal is $1 million plus, and it's actually something that we have to check, we would outsource the due diligence, meaning that we would get a lawyer, a technical consultant, and we would also come to the country to do it. And this also, especially if we are leading the round, because if you are leading the round in that case, you're also responsible for the other investors that would follow on. So you want to make sure that everything is on point. Also, to mention Lolan is that if you are in the pre-seed and the seed, we rarely do the due diligence that you actually hear about. What we do is just we spend some time with you. We ask you for a link to a data room. We go through the data room. We go through your financials. But we don't do actually that is quite, we don't do something that is quite hectic, also from our side and your side. I hope I answered the question.
No, that was great. And just another time to summarize what you just mentioned, right? There's different ways that you can go about it. You can either go on your own route in terms of doing due diligence, and it takes time, right? I think it depends on the stages of the company where you want to spend a certain amount of time on doing the due diligence. As I mentioned in her case, when a deal is raising more than $1 million, usually the due diligence is much more thorough, and you start bringing in technical, so you assure that the product works and is intended to work as described, as mentioned. If it's smaller checks, so if the company is raising a little bit less than that, the traditional due diligence is checking incorporation documents, making sure that the company does what they do. So you look at the data room, and the data room is essentially, this whole it's a folder essentially where all the documents of the company live, which are the titles, of incorporation, anywhere from the different revenue streams that they might have had, their customer, the LOIs, or whatever that could be. And one of the things that we do at Daba is that we do our own all this due diligence for investors, so they don't have to do it themselves. This is one of the advantages that we offer at Daba, that Aya does herself as well. Amazing. So the question was, how can investors who don't have the advantage of your exposure to companies or industries through GIZ, etc., and other career exposure gain technical insight into various industries?
So thank you, Lolan. Actually, I was just about to answer when the internet went off again. But basically, everyone does. There are a lot of ways by which investors get off. There are some investors who basically don't care about gaining the technical insight or the technical exposure, which is usually what's happening with a lot of investors in the ecosystem. That what they do is that they just come in. They. Oh, not sure if you can hear me.
Yeah, we can hear you loud and clear.
Okay, good. So actually, there are investors who don't care, and they just give you the money and then they walk away. So they don't actually look to gain the technical insights or exposure in the various industries. But here, assuming that you mean investors who are actually trying to get technical insights into various industries, what they usually do is just they rely on consultants or other people that they are sure they know about a particular industry. For example, the two sectors that I don't know anything about are, Web3, blockchain, gaming, and the new sectors I don't know anything about, to be honest. So what I do is, instead of not investing in the sector, I kind of get a consultant, or I get someone who knows about the sector very well, and I rely on his expertise when actually I want to, when I want to check a company, if a company is good or not. I kind of, send it through them, and I rely on them. What you might notice as well is that when an investor comes into a particular round, the investor relies on the other investors in the round. For example, if I come into a round that is a $1 million round, and then you see a lot of VCs in there, there are some angel investors that even though they don't know anything about the company or they don't have the technical insights for the company, they just get into the round and rely on the expertise of the other investors within. It's a good question to kind of let all the entrepreneurs also to choose their investors and kind of choose whether they want investors who just give them money and walk away, or they want to choose investors who have the technical insights and try to help there. Now, it's a tricky question, but every company kind of wants to say.
Thank you, Aya, for that in-depth answer. That was great. And I guess now we're just recalibrating, over assessing deals, which I want to make sure that everyone gets more knowledgeable as we exit the session. So Aya, we've touched on due diligence, which is extremely important. Now, are there some red flags that that when you look at a pitch deck, you're like, okay, this is a big red flag? Because perhaps sometimes it really depends the scenario with how you go about deciding an investment. Usually,
okay, I'm not sure if the internet this time is me.
We can hear you.
Let me see.
Can you hear me? So we can hear you, Aya. I wonder if I'm the one who is having the internet connection now.
Yeah, I think I outsource the problem to you, but
can you hear me, Aya?
Yeah, but you're breaking a little.
All right. So what I'll do is that I'll drop the question as well here so you can hear it as well. The question is, what are red flags that you've encountered when looking pitch decks?
Okay, honestly, the first red flag is when the founders are not full-time.
Okay.
So when I see that the founders are not full-time in a company that they're doing two things at the same time, now it differs because it's hard actually. I know that it's sometimes when someone has a full-time job, but then they have this brilliant idea and they have to work on that brilliant idea. But that person has responsibilities. Perhaps he has a family to feed. Perhaps he has himself to feed even at the same time. It's hard for him to get out completely from his full-time job and go to entrepreneurship. So for me here, I'm completely understanding, but the red flag here for me to see if the founder doesn't even have the time or doesn't even have the plan to move in as soon as possible, to the company, specifically after raising the fund. Um, that is something that is completely a red flag. If the market is too small, for example, you see that the market itself is too small, or the founder is miscalculating how big or small the market is, which we see a lot in a pitch deck. Um, but Anthony, usually you don't find red flags or yellow flags even in the pitch deck, because after all, the pitch deck is a sales document, it's a marketing document. So the best thing in the company is summarized in a pitch deck. When you find the red flags is when you dig in deeper. Now, when I dig in deeper, we usually find something like the founder being someone who doesn't, being someone who's not teachable, basically someone who's not flexible, like he's fixated into something that's what he wanted to do. So if we have the feeling that the founder is like that from the start, that's a complete red flag. So we don't usually do it. Now, if the founder is flexible, the market is good. Sometimes that's not a red flag, that's just a yellow flag. For example, we see that the company does not have audited financial statements, which is sometimes normal in Africa, especially if at a later stage. And then you find that there's a mismatch between the financials that they have, in their bank versus the financials that they have, that they have communicated to us. Now, again, for someone that knows Africa very well, it's understandable, taking into account that most of the revenues, especially for a company in Africa, actually comes in cash. So I had a lot of calls with VCs actually thinking that the founder has somewhat miscalculated, but it's actually, he didn't miscalculate. It comes in cash. It doesn't come in via bank account, so we can completely max it out. So there's that thing into the into the financials. The other yellow flag is if the company has a white label, if the tech is not prop, and that is actually quite a yellowish flag, because in the end you would want to scale the business, and I know that they have a white label or another tech partner that is on top of them, which is going to be a little bit hard to scale it. Now, what we do to these companies, specifically if we like them, is that we try to get the company to convert whatever was white labeled into a prop tech, and it's not an easy task actually to take something from this server to the other server. But yeah, this is all yellow flag. But to be honest, all of those are yellow flags. The one thing that is completely a red flag is the founder and his mentality. I sometimes speak to founders that are looking to exit quite soon, like from the pre-seed. All he's talking about is him exiting or him doing something else. So that's a red flag. Everything that I would consider a red flag for startups and early stage companies are related to the founder. Because whether we want it or not, the startup at the pre-seed stage, it's the founder and it's the management. If the management is actually something, we think that there's something wrong in his personality or on the way he's handling, that's red flag. Anything else can be fixed, can be just a yellow flag. If the market is small, we can actually make it wider. We can brainstorm to make it wider. If the tech is not prop, we can make it prop and convert. If the financials don't make sense, we can get an auditor and make them make sense. But yeah, that's actually my take on this.
And I think you already answered somewhat my next question, right? Which was, how much of your investment decision in the business, depends on the idea, solution, and the founding team. For us, one thing I've noticed as well in terms of red flags, the fundraising. There are times that companies are looking to raise much more than needed. It's not really a red flag, but more so a question of, do you really need this much to get to the next round? And otherwise, sometimes the burn rate of certain companies could be a red flag, right? So I've heard here in America of very early stage pre-seed companies raising, $1 million and then burning quite a bit of it. When I say quite a bit of it, is in the 50K and above per month, when you're very early stage. So the burn rate also is an important, I think, criteria that we do look at Daba. Not a red flag, but something to always keep in mind, other than everything you've mentioned. So
Yeah,
so
I agree with this, but the burn rate is actually something that For me, it's related to the founder as well. So here's two schools of thought
Okay.
actually in the startup ecosystem. So there is a school of thought that says, growth at all cost, growth at all cost. I'm getting into a market. I need to really get the leadership position in that market as soon as possible, especially if the market is virgin. And in order to do that, I need to burn. And we see a lot of companies who have actually done this in Africa and that had the investor support in Africa. I mean, renowned VCs actually have supported this burn mentality, especially if they think that that market, that specific market, if we actually try to grab as much market share that we can, we will not, it's a low chance that we will be losing that market share going forward if we just grab it. And that's actually how we're going to make growth, is via burning. Now, the other school of thought, which is actually quite successful, specifically with this economic crisis that happened this year, is that you need to kind of grow while make sure the unit economics makes sense. Unfortunately, Anthony, you might have seen that a lot of companies now in Africa have closed their doors, have shut their doors completely, because they were in the first school of thought. They actually tried to get the lead in share, which they did, but then the unit economics didn't make sense. So even after 5-10 years, they're still not profitable. Even after exiting or having a partial exit, they're still not profitable. And I do agree with you. I'm actually with the second thought.
So
Sorry, you said.
no, I was going to say, you mentioned the word unit economics. I'm not sure
Yeah.
that everyone knows what that means. Could you perhaps just give a little quick high level of what that means when you talk about unit economics?
Oh, sure. So unit economics is actually how much you're making or the economics that you have per unit. For example, let's say, okay, I have a pen. So I'm selling 10,000 pen, let's say per day or per week. For example, I'm selling 10,000 pen. I have to make sure after actually I have all my finances and I know how much I made of the 10,000 pen. Let's say a pen per dollar. So 10,000 pen, $10,000. And how much are my costs to actually sell this? Let's say that I buy the pen with $6, I sell it with $10,000. This actually gives me a $4 margin. Now, the unit economics is actually thinking about one pen. How much do you sell one pen? How much do you make per pen? Not the consolidated one, but how much do you actually make per pen? Now, if I'm buying the pen with $6, or the individual pen, for example, I'm getting it by 5.5, for example, then I have a margin of 4.5 or 45% margin actually that I'm making per pen. And in this case, this is actually my unit economic. The school of thought that says that the unit economics much makes sense is that you must be making money per unit. Sometimes you kind of count all the economies of scale and all the cost consolidation. And then when you go at the end, you see that you're profitable, but you might be profitable overall, but you're not profitable per unit. And actually to build a sustainable business that will actually continue to be profitable, you must make sure that you're calculating your profitability, specifically at the first stance per unit. It's actually better to do it, while doing it consolidated. So this is what I mean by unit economics. It gives a good, it gives you also as a founder a good way to see how much the service or the product that you're selling actually makes you, or how much margin you're actually making. And if the margin is positive or close to positive, to positivity, or the growth is actually apparent, then you have a solid business there. Unfortunately, what we were discussing, Anthony, is that there are some companies that when you actually burn a lot, you're losing money. So the costs are actually a lot. Now, when you burn a lot of money and you spend a lot of money per unit, you're not really profitable at that particular time. There are some companies that are, even though they're burning, they're kind of looking at the unit economics and making sure they're actually positive to scale. And there are some people or some other entrepreneurs that try to scale at all costs, meaning that it's better for me to sell 1 million pens per week, even though I don't make a lot of margin. I just buy a lot and sell a lot. Yes, I do have a good market share, but I'm losing per pen. If I'm losing per pen, even though I'm scaling, yes, I get a good market share, but I wouldn't continue doing it forever, because at some point I need money to count in. Now, in order to actually answer one very important question, a lot of startups are not profitable at the first stage, mainly because the unit economics don't make sense. Mainly also them as a consolidated company, they're not profitable. Now, the thing is, if a company is not profitable, they need to burn cash. They burn the investors' cash, meaning the investors also support that. So when you're raising a round for growth, you get the investors' cash to grow. But think about one thing. In some time, the economy is not good. And when do you see that the economy is not good? You watch the other financial instruments. So investments, as you might know, actually, there's investment in public companies and in debt instruments, such as bonds, for example, or non-risky instruments. There's private equity. There's a lot of type of investments. For us, venture capital or anything like this is called alternative financing. It's actually the smallest part of private equity investments. Now, how do you know that the actual investment is not very good? Is when you see that the stock market is crashing, which has been done now in the US for the past year or so. A lot of investors have diversified asset pools, meaning that they invest into stocks, they invest into bonds, they invest into private equity, they invest into VC also as part of PE. Now, if you see that the market, for example, of stocks is crashing, a lot of investors are lacking the liquidity necessary to invest into companies into the venture space, which is considered as a risky asset. So a lot of company or investors, what they do is that they take their money out from the risky asset and they go put it into non-risky assets, which has been done now for the past year or so, meaning that people are not keen into investing in startups anymore, which means that the cash is low, which means that companies that have been relying on growth at all cost, meaning that if the pipe of funding has stopped, they would immediately fail, which we have seen now a lot, in the past year, whether in Egypt, whether in Kenya, whether in all of Africa, even in Morocco, we have seen something like that. Yeah, I think I gave an explanation of financial economics and even dwelt through
That
it.
was a very thorough explanation. Thank you so much. I'm sure those who are watching this now, who will watch it later, will definitely be grateful for such a thorough explanation. I don't even think you will find on Investopedia a such thorough explanation of unit economics. So thank you for that, Aya. I know we're getting towards, we're getting up on time here. One question I had, right? One of the most questions sometimes that we're faced with when analyzing and assessing a startup is the founders, right? And the founders are really one of the reasons why you invest in them early stage. How important for you as an angel investor is the fact that the founder has a lot of expertise and understands the market very well, on the one hand, and number two, if the founder is building a tech-enabled business, how important for you is that for at least one of the founders to have a CTO? That is something that's very recurring. And I know that even some accelerators, incubators do not even consider companies that are looking to, pretty much they want to do tech-enabled business, but they don't have a technical co-founder. So would be great to hear your thoughts on this from your angel investor hat.
That's actually, that's very interesting, just because I had a situation just last week. Now, I had this company. Perhaps it would be good to answer it for an example. And being an ex-entrepreneur myself, I know that we can come as investors and say that we like this and we like this perfect formula, but sometimes it's not doable for entrepreneurs. And sometimes you just listen to them and listen to what everyone says. Now, why is it not doable to have a CTO at the first stage? If you're not fortunate enough to actually have studied with someone, or your best friend is not a technical guru at the first start, you pretty much doomed into having to hire a CTO, and CTOs get paid a lot. So what a lot of non-technical founders, and I think this is the problem of non-technical founders, that they have this amazing idea, but then they have to figure out a CTO or a technical person who would build the idea for them. Now they have two things. I, for example, when I had my company, it just happened that my best friend is a tech guy, and he agreed to actually do it and co-found this with me. But if you don't know someone who is a tech guy and you just have to go through it, two things that people do: they outsource it. They go to these tech companies or these tech, let's say, what do we call them? Tech studios?
Develop dev shop.
Exactly.
Studios,
The dev shop. The dev shops actually builds them. They build them, they build them a couple $100,000 if it's a very hard, technologically hard, company, or they build them like a few $1,000. Now, the company at the start doesn't have that money to pay for the dev shop, so the dev shop takes equity. So you would come to the cap table of the company, you'll see a dev shop X having 30% of that company, and most of the dev shops are in India. So you see something funny, like a dev shop X who's based in Bangalore has 30% of a company that is based in Nigeria. And it's a dev shop. So they're not CTO, they're just CTO in residence, meaning that they just make sure to handle the technology as it is. And this is actually quite dangerous and it's close to a white label. And you see other companies having the second thing, which is a white label. Or you see, which is actually now a job description, a few companies, a few people who are actually CTO in a lot of companies, which just happened to me last week, actually. I've seen a face as the CTO of at least 3 pitch decks that I have seen. And he's a CTO of all of them, just because he works at a dev shop. And what they do is that he kind of helps build the technology in CTO, all of them. This is a yellow flag, by the way, because you know that like the technology is not targeted. Now, what we can do with these startups is 2 things. First of all, understand them, their situation, that they were not lucky enough to have their best friends as a tech guy, which is normal. Second of all, for me at least, if they have at least like an MVP, a minimal viable product, if they at least have that, they kind of need the money to hire a CTO. So what we do is that they give them the funds at the pre-seed level, we get a good valuation. And the first condition for us is, with our money, please hire a CTO and make sure that everything, makes sense. The third thing is that in Morocco, for example, there are a lot of universities that now offer, good programs for the CTO graduates. For example, in Morocco, we have a school called the 1337, which is based in Ben Gurir. In this school, for example, after graduation, they kind of offer technology development or CTOs or tech people the opportunity to work into startups. So there are ways now, fortunately, there are ways in order to get CTOs for cheap. And what we would like the entrepreneur is just innovate around that way. Having a CTO is extremely important. Having it the right way also is extremely important. So you just need to innovate around it and find investors who would actually give you the money to do it properly instead of getting a white label. That's actually what I would advise.
No, that's a great answer. And I think what's really important here is also to think at what stage, right? If you're a pre-seed company and you're outsourcing your development, it's something. But if you are getting to the point where you're Series A and you still do something like that, that's definitely a big red flag. I don't know that many companies do it, but that would be a big red flag. Amazing. I think we've covered quite a bit of questions today. I would like to pause a second here and see if anyone in the audience wanted to drop a question to you specifically. So, for those who are listening to us right now, feel free to drop questions. I know we're already getting closer to the hour, and I want to be mindful of Aya's time, who's been so generous to be with us today.
Happy to.
And we'll just give it a minute.
Of course.
All right. Very good. Lowland, we appreciate your engagements. I'm going to show the question. So Lowland is on fire today. We appreciate that. Apart from teachability, what other characteristics do you look for in founders?
Okay. Now, so first of all, stamina. I always say that I'm not sure if some of you were in the GITEX that was held in Dubai about 3 weeks ago, but we had the same question there. And the first thing that I see is stamina, because founders in Africa are actually met with much more problems than any region in the world. For example, you want to make a company that's, you want to make an Uber-like company. Uber was able to make it just with the technology and they have the internet available. But when you go to Africa, you have a lot of people who don't have internet. You want to do a fintech, you find people that are not even bankable. So you see a lot of issues, in Africa that need to be fixed, meaning that you as a founder, you have to be adaptable, flexible, and also have stamina to hold these things. I look for entrepreneurs who actually have experience in their chosen field. For example, if the startup is in retail, I'd like to see that the founder has experience in retail. My one last insurtech company in Egypt that I actually met like a month ago, I liked the founder because he's family's business is insurance. So he was basically doing insurance all of his life. And then he decided to go and do an insurtech. So having the founder having the experience in the chosen sector is actually quite important as well. I look for founders who are not actually, yeah, they're able to be taught, but in the same time, they are quite generous themselves, and they're not few people who would actually, play tit-for-tat with me as an investor, like over negotiate or overdo everything. Because in the end, we're all here trying to support. So it could be good for the founder himself to kind of recognize that the people that want to actually come with him, they're coming as partners or as co-founders even. So it could be good that he's not over tipsy in that case. The one thing also is that I met some founders who like to be the center of everything, and I've seen that actually a lot. And it's understandable, because in the end, there are some founders who think that they can do actually everything in a good way. But what we would prefer is that if the founder is able to delegate at some point as well, is able to share the company with someone else, and is also able to delegate some of the tasks to someone else, not to over delegate for the way that there are people who do everything, he doesn't know anything, but basically just be able to kind of share the knowledge that he has with other people and being with them. I'm not sure if I forgot something. What do you think, Anthony? Anything that I forgot?
I think you touched on a lot of things. What else could I add? Thinking out loud. I think, you know, it depends in the type of companies that you are. It depends on what business you are. But to your point, for me, technical knowledge is very, very important. I mean, I know we already touched on this, but I think technical having a CTO is extremely, extremely important if you're really doing a tech-enabled companies. And I know we call it CTO, and perhaps that was my mistake. CTO is a very fancy title for someone who leads kind of the technology department. In the early days, it doesn't have to be a CTO. You might not even have a CTO. It can just be, a software engineer. Perhaps that's who you call your CTO. I think that for me is a really, really important one. I would say understanding the business, but I think you already mentioned it, being able to understand your total addressable market. I think one important one is understanding who you're servicing. Sometimes, I've experienced, reviewing certain presentation or certain pitch decks, even in calls, where the founder was not sure about who their audience or their customers were, and that it is really important to understand who it is that you're servicing, who is it that you're addressing your product for, who you're solving this problem for, is very, very important. But I think other than that, you've touched on pretty much all of the different points. So thank you, thank you so
Right.
much, Aya. I just want to see if so. One, I just guess I just want to add on two questions here. One question is, if you were to go back to the first time, like let's say now you have all this knowledge, right? You've been investing for a couple of years. You've been angel investing for a couple of years. If you had to go to someone, we have people in our audience here who are just getting started. What would be one or two advice that you tell them with what you've learned as they're getting started? Like just two things that you think they should really always think about when they're thinking about angel investing in startups.
I would say be teachable as well. I would say that anything that you would tell the entrepreneur to be, you need to be that as well. Meaning that an investor is kind of a half entrepreneur as well. It's just an entrepreneur who doesn't want to go into operations, basically, in startups. So you're an entrepreneur who doesn't want to go into operations. So just as much as we want the entrepreneur to be teachable and flexible, we need to be teachable and flexible as well. Because a lot of times, what makes me right now is the fact that the entrepreneurs that were with me taught me also their sectors and their respective sectors. And a lot of times when you get involved, sometimes you don't agree with the entrepreneur. Sometimes an entrepreneur is doing a sector that you don't agree with the viability of that sector. And actually I had to learn this the hard way, because as I said, at first I wasn't really believing into the Web3 one and into the gaming one. Actually, gaming and Web3, I didn't believe in it. My chain of thought was that in Africa, we have much more issues than we actually need something about gaming, even though it's a viable market. But for me, I thought that we just have a lot of issues that we need to concentrate the money on. And I met an entrepreneur 2 weeks ago in Dubai actually, and he convinced me otherwise. I ended up investing after 30 minutes of talk, basically. Because again, being teachable and learning from the other entrepreneur who has been in that sector for a while is something that is quite key. Um, Perhaps there are a lot of things that I would advise, but the first and foremost thing, be as much as you want the entrepreneur to be. Try to put yourself on their shoes and understand them. There is no rule book. Yes, we do have rule books about how to angel invest and how to invest and all that, but it doesn't make any sense if you're not actually adaptable enough to understand what the entrepreneur wants and what the issues they have. So instead of actually meeting an entrepreneur and tell them, oh no, you have to have a CTO, no, you have to be full time. I'm not going to invest in you if you're not full time. Try to understand why the entrepreneur is full time and how we can actually make that, and how we can make a solution to bring him full time. There are entrepreneurs who don't want to be full time, which is understandable. There are entrepreneurs who want to be full time, they just cannot do it economically. They cannot do it. Imagine if they have kids and a wife who wants to buy a lot of stuff, and then in the end you keep telling him, no, you quit your job in turn so I can give you money. Sometimes it's just unfair. Yeah, so be an investor, try to look for your profits, but also be human, and this way we can actually make the entrepreneurial ecosystem much better.
This is amazing. On this great note, I want to thank one more time Aya. Thank you everybody who's been able to join us today. And to all of those who are joined today, as mentioned, we do have some sort of course, just main headlines about things that we've discussed today, things that we've discussed on our previous webinar that aims to help you just learn more about even theoretical stuff, ways of evaluating companies, even though it is not something that you might use on your day to day, but just for your reference. So we will be sending that to you, and you should be able to access it starting Monday. So thank you, everyone. Thank you again, Aya. Wishing you all a happy Friday and a happy weekend. Thank you, everyone.
Thank you, everyone. Thank you. If I may just mention one thing,
Yes,
Anthony, if anyone here wants to contact me, please, you have my LinkedIn. Feel free to contact me, especially you, Lolan. I can see that you have a lot of questions, and I'm more than happy to actually, see how we can help each other or see how anything can be done. Thank you so much
absolutely.
for doing that.
Great comment. Same here. If there's anything we can do to help you, happy to support and answer any questions. So thank you, everyone. Bye.
Thank you. Bye.